Welcome, ladies and gentlemen. My name is Amlan Roy, and I'm very honored and privileged to moderate this August panel, but also to pick up on what President Thurman talked about. I want to talk about why aging is a very pressing issue that most of the world has not managed to cope with, and I've been advising governments for the last 23, 24 years. So let me give you a few facts. He mentioned Japan. So in a document in 2000 called the Demographic Manifesto, we said that Japan, Italy, Germany, etc. have 4 solutions: flexible, enabled retirement of old people, empowering women, use of technology to better balance solutions, and selective migration. Many of the countries have still not adapted to those things, so much so that today the fastest growing age group in the world is the 80 plus. And that is the problem. The 80 plus age group in Singapore, Japan, Germany, Italy is growing at 4 times the rate of the average population increase. And nearly 70 to 80% of European taxes are going towards supporting the rise of the 80 plus population. So when people next tell you, look at the retiree population, say it's not material to look at the retiree population. We need to divide the population of retirees into 65 to 79, the young retirees, and then the old retirees. It's the old retirees which are the biggest burden on European debt, Japanese debt, Singaporean debt, etc. And I'm going to conclude on my first point by telling you no country in the world has enough money to pay for 30 years of retirement expenses in the world, even the richest country. So that's the first point. The second point I want to tell you is, I'm a researcher, so I'm going to share with you a paper we wrote which says retirement planning requires changing mindset, changing tools, and changing asset allocation. All these 3 things are very, very important, and fintech is one way that we can leapfrog geopolitics, politics, bureaucracy, sluggishness, and benefit from behavioral finance advances. So that's where I expect my co-panelists to shed light, and they are experts in their areas, having worked in countries from China to US, to Rwanda, to Kenya, to Papua New Guinea, Philippines, Indonesia. So we have global experts here who've changed the dial, moved the dial on pensions, insurance, and savings. Before I hand it to them, I want to highlight something that I've been talking about last 25 years. It's more important to me than climate change, and it's also more important to me than retirement. And that is how gender unequal we are. So we wrote a paper where we showed that women in the G30 countries are better educated than men, yet they are given 19% less jobs and paid 23% less. If the world were to be more equal and we had gender equality, debt in the world would go down, income equality would go up, growth would go up, and sustainability would go up. And again, I believe fintech and technology can help lower gender inequality. And with that, I'm proud to introduce you to my first speaker, Dr. Jason Wei, who's a finance professor turned practitioner, written papers on bond markets, on COVID, on fintech, and he's the director of fintech at Tsinghua. The way this panel will be run is, he will give opening remarks for 6 minutes, followed by the other 2 speakers who I will introduce. Maybe I should introduce them now itself. Second, we would have Namrata Jolly, who's the Asia Pacific Business Head for CallSign. And last but not the least, we'll have Gautam Bhardwaj, who's the co-founder of Pinbox Solutions, a micro pensions fintech application which is being used in many emerging markets. So without further ado, Dr. Jason, over to you.
Thank you so much for Professor Roy's introduction, and hello everybody. It's great to be back. This is my first time back in Singapore in 4 years, so it's a true pleasure, and thank you for the organizer for this opportunity. So I think this topic actually is a very timely and very challenging. It's a global issue if we talk about aging, and it's a more severe issue if we look at China. As Professor Roy mentioned the several numbers, I think in my past few years making observations in China, I see actually we have not only the number, but in terms of a birth rate, marriage ratio, and in terms of the portion of old people living alone, all these actually are adding up to the aging problem. And also, we're just starting to build our system of what we call third pillar. Basically, it's an individual retirement account, like a IRA or 401k. That system in China, we're just starting on it. So the problem is very challenging, but I think the opportunities also is very significant, especially given the latest development in fintech and the large language model, the new latest breakthrough in artificial intelligence. I think it offers lots of new opportunities. I would just briefly mention this to everybody and share with everyone. So I think for this aging problem, technology definitely is the must-have tool if you want to address it in a more efficient way. And we can see this from three aspects: the individuals, the institutions like a pension or insurance, and the regulators. So the individuals, for a country like 1.4 billion people, the first thing is you have to reach them to provide the knowledge and provide the products and provide the service. That's where technologies, especially mobile technologies, can help in great way. And that's what we see in China right now. More than 75% of the people are using cell phone. So the mobile devices actually give them, no matter where you live, you can live in the mountain area, rural area, have basically a very easy access. And then for retirement, you need a lot of education, because this is a lifetime thing. You can't wait till 65 to start thinking about this. So the education, the information, and get the knowledge on products, services, all this can be really, really improved by technologies. And that's where I see lots of activities. I was just talking with Professor Roy backstage about WeChat. I'm sure many of you are familiar with. That's a good platform I personally cannot live without, getting lots of information on my retirement and product, et cetera, et cetera. So for institutions, I think what we see, I just spent 3 weeks, by the way, in the US through New York and the Silicon Valley. So I think on both sides of the Pacific Ocean, this very active efforts to further engage fintech, especially artificial intelligence, into all sectors of financial products and services, and not just pension and retirement. I think like Morgan Stanley, BlackRock, and traditional insurance companies like AIG or Prudential, they're all very actively exploring new ways to use the latest AI technologies to enhance on several very important things. One is how to better manage the money, right? In terms of managing a portfolio, how to do the allocation, how to better do research and capture the risk and find the best optimal portfolio formation, and how to do better customized products. Because for different people with their own characteristics, you have to do customize the product and services. That's where data analysis and artificial intelligence can help in a great way. There are already startups doing this and providing SaaS service for the big companies. And this becoming a very exciting area for future acquisition of these startups. Yeah. So the whole basically the whole chain of innovation is still there. Yeah. Despite the fact the IPO market is down a little bit, but more than 90% of innovation and the startups, they exited through acquisitions. So that's where I think for institutions, further embracing this digitization and technologies will help in great way. And lastly, I think for regulators, for surveillance, for policy response, and for their regulation iteration, they can all use large data to better monitor and aggregate all the information. So that's another frontier. So I can further elaborate later on, but I will just stop here. And thank you again for for this opportunity. Thank you.
Thanks a lot, Jason. And let's now turn over to Namrata, who's going to talk to us about insurance.
Hi, I hope you can all hear me. So first of all, thank you for this opportunity. I think this is a topic that is not spoken about enough, not debated enough, and is clearly a time bomb that's ticking away. We're facing today a multi-trillion-dollar pension gap, and this is not just for the developing economies. This is also something that the developed world is facing and is a harsh reality that we are walking towards. I'm going to take the opportunity to paint a perspective across Asia, Africa, and Latin America. So, looking across a 2 billion, working non-salaried population today of adults, these are folks who are not covered by a formal pension construct. And when I say non-salaried, what do we mean? It's not that they don't have access to incomes, but they do not have access to fixed, stable incomes. These incomes are intermittent. These are young, economically active folks who work for MSMEs, who work for the gig economy. And we know in a large part of Asia, Africa, and Latin America, you have large populations today who work in the gig economy. In countries like India and a lot of other countries across these 3 continents as well, where agriculture is a large part of the GDP, you have farmers, you have other people who are self-employed, and these folks do not have access to a formal pension construct today. And this is very, very worrying. So if we look at the 2.4 billion population of adults that I spoke about, I'd just like to take the opportunity to break these down into segments so we understand what is the problem that we are looking at. The interesting thing is that a large proportion of this population do have access to a bank account or a digital wallet, but less than 25% of this population is actually saving for their old age. So we are going to be seeing a huge set of folks walking into old age with no savings. And this is going to be a huge burden on economies. So the 2.4 billion adult population that I talked about, of them 1.2 billion adults don't have access to a formal pension construct, but they do have the ability to save. Then you have the 0.6 billion who have access to a formal pension construct, but unfortunately the pension construct is not one that provides them with great pension benefits. So they have pensions, but these are not really pensions that would cover them in their old age. The fees are too high, these are not portable benefits, and so on. Now, in addition to that, we have this demographic time bomb that's ticking, right? Across these continents, 8 out of 10 elderly people, so out of every 10 elderly people, 8 elderly people are going to reside across Asia, Africa, and Latin America. So 80% of the elderly population is going to be across these 3 continents. And the way we are going right now, if we don't really change course, 75% of our elderly population will not be backed by a pension. And this is not something that we can turn a blind eye towards. This is a huge problem. You can imagine some of these folks walking into abject poverty for almost 20 years once they are too old to earn anymore. And why is that? That's because we are living longer, we have access to better health care, we have access to better food and nutrition than we had before. These are big problems that we are facing today. I'd also like to shine a light on the plight of women. Women are much more vulnerable than the men today. Why is that? We outlive on an average the average man. In addition to that, women see multiple interruptions in their ability to work today. So when you have a child at home, it's the wife or the mother, who takes a break from her work. As we are seeing the elderly population, when you have elder folks at home, again, it's the woman who ends up taking a break in her, ability to work, and therefore intermittent incomes. So this is a problem that we are seeing and is only going to aggravate further if not enough steps are put in place. I think the third aspect across these 3 continents, which requires quite a bit of attention, is the insurance gap. And this is basically when you're looking at a population that's not very aware of the fact that they need to be able to insure themselves against health emergencies, an accident insurance, a critical care insurance. If you're in a country like India or China, where there's a large population that deals with the agricultural sector, but you have a problem to deal with, like your crops went bust, or your livestock had a problem. Getting insured for crops, for these kind of disasters, what ends up happening is, because people are not insured, whatever little savings they have then get diverted towards these life emergencies. So you have absolutely no monies in place to be able to save for old age. Now, while I'm painting a picture of gloom and doom, there is absolutely a silver lining, not a silver, I'd say there's a golden lining, but there is work that needs to be done. And the matter of fact is that if even 10% of this population were to start saving $1 a day, we would be looking at $1 trillion of aggregated savings over just 1 decade, which is a phenomenal amount of money. So with that, the question is, with such a huge problem that we are facing today, and the fact that these populations have the ability to save, why are we not moving ahead on this? What are your thoughts, Gautam?
Thanks, Namrata. I completely agree. The fact that we have a very large population not saving for old age, we could be looking at a problem which is as big as climate change. But the flip side is that if we could actually get these people, even a fraction of them, to start saving for their old age, this could generate a large pool of new savings in the economy. So the good thing is, of course, that I think the building blocks, and we've done studies in over a dozen countries. In each country, in each developing country, we find that the building blocks for inclusive pension already exist. So you've got the entire supply side ecosystem on whether it is digital payments, digital national IDs, and digital public infrastructure. You've got pension funds and insurers who are really hungry for new markets and are looking at a new base of customers. That clearly exists. Today we are finding governments are also realizing exactly what you're saying, that if we don't do something, or if we delay action, then we could be facing very severe and sustained fiscal and social stress. But if we can actually get things to move in the right direction, this could generate new income, new long-term savings, which can have a positive impact on economic growth and employment and all of that, right? But what are the reasons why people are not able to save? I mean, despite everything being there, one of the reasons, of course, is that people are still very young. In most developing countries, people are still very young. I mean, in most of Africa, you're finding most of the workers are in their late teens or early 20s. And retirement really seems very, very far away, and that's one reason. But I think there are also other reasons. One, most pension systems worldwide have been built for formal workers. Whether I look at what's happening in Singapore or in other countries, most of the pension systems, processes, products, everything has been traditionally designed for formal sector salaried workers. They're not equipped to deal with individual informal workers. They can't deal with farmers or street vendors or domestic help and so on and so forth. The second reason is that while a large pool of new savings are feasible, the traditional sales models of pension funds or insurance companies are very pro-rich, and again are not tuned to the needs of lower income people. So for instance, most pension funds, insurance companies or finance firms typically depend on tax breaks or agents for cross-selling or for attracting customers or for product sales. Now unfortunately, agents are not interested in lower income people, and tax incentives don't really work for people who don't pay taxes. So, and the third reason we find is that the level of knowledge that people ought to have and the level of confidence in formal finance, because people are not using formal finance, is very low. So what we are seeing is, and this is something that we're doing, it is feasible to use technology to break a lot of these things. And I'd like to just mention the case of Rwanda, which is a small country, about 6.5 million people in the workforce. They deployed the Pinbox model in 2018, and before they worked on pension inclusion, the total number of people saving for old age in Rwanda was about 5%. Okay, what the government did was it said, okay, we will create a legal and regulatory framework which will enable people to save. We will build new technology which is specifically going to help in delivering micro pension products. And the third they said was, we will provide budgets for mass scale public awareness and fiscal incentives. So they said, we will actually co-contribute because a street vendor doesn't have an employer. We will step into the shoes of an employer, and every time you save $1, we'll put some money into your account. Right? The second thing they did was, they said, okay, if people don't trust, say, a Prudential because they don't know about Prudential in, say, Rwanda, they said, okay, can we use trusted community organizations or community networks like cooperatives and others who became the face of this new national micro pension scheme. So customers who were dealing with these cooperatives and NGOs started dealing with them. And the third is from a fund management, etc. point of view, they started outsourcing it to private firms. Payments were done by private payment companies. And today, in 4 years, they've gone from 5% coverage to 55% of the workforce actually saving for old age. So I think it can work. It just needs a collaborative and cooperative action by multiple stakeholders. The good thing is that the building blocks exist.
Thank you, Gautam. I'm just going to, before I turn over to asking follow-up questions, I want to use the chair's prerogative to give you a bit of perspective. Many of you might think that this is a retirement issue. The problem of retirement today affects 8.2 billion people in the world, which means every citizen, every consumer in the world, and 5.8 billion workers. Why? Because the retirement savings of people in their 60s, 70s, 80s in Switzerland, in US, in Canada, and India is often helping the younger generations to come up the property ladder, pay off their student loans, consumer loans, etc. So I want you to think about something that the world hasn't been paying enough attention to. Today in Singapore, you have 5 generations alive. A 91-year-old who has a 73-year-old daughter. The 73-year-old daughter has a 49-year-old who has a 26-year-old and 1-year-old twins. 5 generations are alive. About 7-8 years ago, I talked in this forum and spoke to the government of Singapore. But not just the government of Singapore, in Japan the same thing, Canada the same thing, and we really need to think about how 5 generations are going to defray based on 1 generation working. And when here we are talking about retirement and pensions, we are talking about a 5-pillar pension system, not just the social insurance or the second pillar. We are talking about all pensions, all savings, and insurance. I want to kind of highlight that when Dr. Jason talked about Chinese fintech, how does fintech help? Fintech helps pensions, first of all, in terms of creating the incentive to save more towards pensions. It helps with big data, AI, as well as machine learning in terms of pension investments, longevity risk measurement, measuring equity risk, as well as operational risk. So fintech has the ability to improve efficiency on lots of aspects of pensions, asset allocation, and risk management. And last of all, in terms of delivery of the pensions. We also heard that from Namrata that yes, all these things are possible, and we are currently unfair towards women. But I also want to highlight that Asia is no longer a young country. Asia ceased a continent. Asia ceased to be a young continent in 2010, where the working age and the population growth of Asia became lower than the world population growth. So I've argued in 2011, 2012, number of times in New York and rich countries that we should no longer think of Asia as a young continent. The young continent today are parts of Latin America and Africa. But to get the demographic dividend from all these things and to ensure a fairer society, we really need fintech to empower women, to empower the youth, and to democratize finance. Because currently inequality is at an all-time high after the COVID, because the emerging markets are suffering the crisis of unorganized labor losses. And I finally want to comment on what Gautam said. Behavioral finance, and we've seen in US, UK, Australia, auto-enrollment and other ways of incentivizing people to save. All these things can be done with the use of apps like are being used in Rwanda, in Kenya, and incentivizing old and young to save not just for, let's say, their pensions or retirement, but also precautionary savings. Now I turn over to Dr. Jason for a follow-up question. Dr. Jason, would you like to give us examples from the Chinese sector? I know personally on how well NPS has done, how well Ping An has done in terms of reaching the rank and file of people in lot of the districts, in lot of the provinces of China that earlier there was lack of penetration. So insurance, etc. If you can give us a progress update on potential as well as current performance of fintech.
Sure. Yeah, I think that's actually a great question. I think this outreach question is, as I mentioned, it's the first step you have to take. So I think all the institutions right now are taking great advantage of the mobile devices, especially through very powerful channels like WeChat. You can today basically live in WeChat for almost everything: work, life, study, interacting with people, etc., etc. So through powerful channels, through your mobile devices, institutions can, first of all, push lots of information and do lots of early stage education, especially for people like in the rural area and even in their 30s, not in their older age, to talk about the importance of getting, the proper insurance and start your pension planning, etc., etc., and then start offering, products and advice in terms of how to plan these things out. So I think that's one good example. Almost everybody, the competition also is very fierce. Everybody is trying to use these powerful channels to influence and educate their customers. And also, I think in terms of some traditional ways to serve the customers, one good example is a call center, right? We used to have this call center handling all the phone calls. I learned just last month from Ping An. 20 years ago, they built a call center, probably the first in China, with 50,000 people working in that call center just to fielding calls. Nowadays, they only have 10,000 people, and more than 82% of the calls are being handled by robotics, automatic processing, RPA. So that's just another great example how technologies can help enhance the efficiency. Yeah.
Thank you, Jason.
Sure.
My question now to Namrata in the next 2 minutes is, how does she think technology can solve some of the issues that she's raised? And then we will move to Gautam.
Yeah, absolutely. I think there is a huge opportunity for technology to play a part, and in fact, I think in more ways than one. So let's first talk about the problems. Lack of awareness. People don't understand, youngsters in their 20s, retirement is too far away. Who needs to save now, right? Not necessarily the right approach to have. So the need for improving awareness. Second thing is complexity of terminology. People don't understand what a pension product is for. People don't understand insurance, right? And this is also a call out to insurers to please help and make TNCs readable, and for people to actually understand what are in the TNCs, right? And what do these products actually provide for? What am I not covered for? And then the third thing is complexity of onboarding and ongoing engagement. And exactly to, and just taking each one of these one by one, but what Dr. Jason mentioned, looking at an ecosystem like WeChat, which in other markets could be WhatsApp, where consumers are living their daily lives on these ecosystems, ensuring that we make pension and insurance as easily accessible to them as making it available as you're interacting on WhatsApp. And the phenomenal thing is that Parul and Gautam, who are the co-founders of Pinbox, which is Pensions in a Box, have actually made that happen in some of the markets already. And this is the power of technology. So here we are looking at the ability, and I'm going to just make it simple, give you an example. Let's say we are talking about a ride-hailing app, right? I'm a cab driver, and I do not have access to fixed incomes. What does that mean? My incomes are intermittent based on the way and the number of rides I actually have. So let's say in a week I get about $200 is what I can make. Now, I am not someone who has the ability to get into a completely formal, structured pension scheme that says, you know what, I deduct $5,000 from your account every 6 months. No, that will not work. But me as a cab driver, having access to WhatsApp, so first of all, getting onboarded really quick, right, within seconds, getting onto a pension account, being able to set up parameters myself, saying that, you know what, whenever I'm at a $500 income range for the month, I will be able to contribute $10 towards my pension. But I have the ability to reduce that in situations where I don't end up making that kind of money. So making the pension products really simple, bite-sized, where people are included, all these populations get included. The second thing is making I did mention that, onboarding experience really simple, but additionally, making the engagement really powerful. And what do we mean by that? We mean intelligent nudges. And what that is, people fall off. We fall off disciplined approaches towards contribution, towards ensuring that we have right savings. This is where technology can help say, you know what, you have done a great job of contributing over the past, 7 months. This is what your pension, your contribution is looking like right now, and this is what it compounds to in 10 years. So stay on track, and you will end up having a pension that will serve you and your family well. So technology can really help bridge the gap and provide phenomenal outcomes. And very quickly, I know we are running short of time, but just very quickly, this is the power of pension tech ecosystems, where you have a piece of technology which is completely API driven, which can plug and play into all the other partners or stakeholders of the ecosystem, whether they are insurance companies, whether they are fund managers, and not to forget, some very important parts of this pension tech ecosystem are drivers like a national digital identity. Singapore is very fortunate to have one. Countries like India, there are other countries which are also coming onto the bandwagon. Being able to identify and verify people as they get onto these digital ecosystems and platforms. And therefore ensuring that we are able to intertwine, make these pension accounts easily accessible and portable. So I think there is huge hope and huge opportunity to make a difference and to resolve this time bomb and detonate it before it actually explodes.
Thanks a lot, Namrata. Namrata has taken care of a few of the questions out there, but let's move to Gautam, because some of the questions which are coming to us are things I've addressed in past years. Some of it is in my book last year, which I released in Japan, and I couldn't come here speaking to the largest pension fund there. But Gautam has an insight as to how in countries like Rwanda or Indonesia or India, things can be scaled up, because he's been doing this for last 25, 30 years. So Gautam, would you like to tell us how technology can help with the scale?
Thanks, Amlan. I think step one really is you need technology which is specialized to deliver micro pensions. I mean, you can't sort of, retrofit a formal sector pension system, products, processes, and a lot of these are built on old technology. So you need to sort of wake up today and say, what is it, that we can do today using tech? And let's use that to build new technology. Now, unfortunately, that's very expensive for countries to do, from scratch. So one, I think, is readily available pension tech clearly. But I think it's also important to figure out how to, and there could be many ways. So for instance, to Namrata's point, if we can take a more life cycle approach, not only think about retirement, because at young age, retirement is still too far away. At my age, the story is already over, Now, if I haven't started saving already, the only hope I have of, not living in poverty for very long is to start smoking very aggressively. So my sense is, I think to make it attractive, you could add insurance, you could add sidecar savings. So let's say if I save $1, then 10 cents should go into an insurance basket which protects my income volatility. There could be, say, 60 cents which goes into a retirement account, and 30 cents could be for emergencies, children's education, and so on and so forth. So I don't have to unbundle the contributions, but I put in $1 and this gets unbundled using tech at the back end. That could be one way. The second, to Namrata's point, is that if you can allow people to save as they earn. So let's say a Uber driver need not be saving. So if, let's say, in India he's earning $400 a month, he could save $40, but he never has $40 in one go, and that requires planning. So what we're saying is, can you save $1 a day? And the normal response is, oh, well, $1 a day is, I could cut back on a coffee and, that will go into my pension account. So making it easy and simple. The third, I think, is fiscal incentives, where governments could step in and say, I will co-contribute. Or let's say our gift-to-pension model, which we've been discussing with Namrata also. Let's say you have foreign domestic workers here. So instead of only the government stepping in and doing something, I as an employer, or let's say, you, Dr. Jason, as an employer, could you help your domestic help and maybe co-contribute for her? So, incentives always help. I mean, there could be many other things, but these come to mind readily.
Thanks a lot, Gautam. And I'm going to answer one of the questions and move the next one to Jason and then to Gautam. So the question I've got is, given labor shortages, why doesn't the public sector consider moving retirement age? So in 2000, in a document, Demographic Manifesto, I suggested abolishing fixed retirement ages, have flexible retirement ages linked to life expectancy. That's happening already in few countries, but others need to do so too. The second question was, is it fair, how to protect pension funds from imploding, given that they've invested a lot in US Treasury bonds, which have not done well? And I'll leave that to the fixed income expert, Dr. Jason, to tell us how asset allocation, following the practice of the 60s and 70s that we taught our students invest in government bonds, has not been quite right. So, Dr. Jason, over to you.
Okay, I think the first question, actually, I was at a conference in China 2 days ago. There is actually active discussion about pushing out the retirement age in China, because that seems to be the logical thing to do.
Absolutely.
Yeah, and in terms of asset allocation, I think, again, I'm a true believer of technologies in this issue, that technology can play a big role, because it ultimately is a better way, more precise way to measure risk for different dimensions, because we're talking about a long investment horizon for a pension fund. So you have to have more information, better way to digest and to decide the mix of your assets, not just simple 60-40. So I think that's where when I was at AIG, we actually used Aladdin, offered by BlackRock. That's one of the most powerful tools. You can do very comprehensive, full picture analysis about different sectors, and on an ongoing basis. It's just not like a once per year. So you have to much better utilize the information, use better algorithm to do the calculation, do the trade-off, almost on an ongoing basis. So these days, I think with the big data availability and with the more power offered by AI, I'm actually optimistic. I think this area can be better handled. Yeah.
And also the Fed is using big data and AI.
Absolutely.
There was a question which I want to throw towards Gautam and Namrata, because they've done a lot. How do we incentivize regulators, private sector, public sector, individuals, households to join us all as part of this fintech AI journey for a better life cycle, as you mentioned, Gautam? So let's first start with Namrata and then over to you.
Start with Gautam.
Okay.
Okay, you take it.
So I think it's all about incentives, Amlan. So, and our behavior is always driven by incentives. And the way I look at it, pension inclusion aligns everybody's incentives. The governments have the right incentives. Finance firms and digital finance ecosystem players are clearly incentivized if this succeeds. And individuals, of course, will then not face poverty, and therefore they have an incentive to save. I think as we've seen in countries like Rwanda, what it really requires is strong leadership and commitment. It needs good governance, and it needs us to stop thinking about retirement as a long-term issue. It's a issue today. Like climate change, it needs urgent action today. Otherwise, I mean, if we succeed with climate change, the next big challenge is old age poverty.
Yeah. And that's a big problem. Namrata, any thoughts?
Yeah, no, completely agree with Gautam on this. I think there are all these multiple stakeholders that need to come together. And I just want to take the opportunity to highlight that even in Singapore, where we have platform ecosystem exists, right? Whether it's ride-hailing apps, the super apps, delivery operators. So up until now, we haven't really had them. People who work for these operators are considered contractors or have been considered contractors. But now CPF has come in and has said that as of 2024, next year, they will actually put in place a construct whereby it becomes mandatory for these platform operators to contribute, and the government themselves are going to co-contribute to Gautam's point, what's being done in Africa as well, at least to incentivize the early years of adoption, of contributing towards pension. And therefore, I think it's not a one size fits all or a one partner kind of a solution. We need the private sector, we need the public sector, we need the technologists all to come in place to be able to resolve this problem together.
So I want to conclude by saying something I've said twice before at this conference on the big stage, that we cannot solve the pensions problem by itself. 2017, on the big stage, I said it, we need holistic solutions to solve education, labor, pensions, as well as technology together along with multiple partners so that we can solve the healthy living issue. If we can't get people to live healthily at age 60, 80, and 90, then we can't talk about good retirement outcomes for them. So it all starts with saving, which Pinbox Solutions and Gautam, Namrata, and Parul have talked about over the last 15 years. Get people to save, then get people to save for retirement, for precautionary uses, and the industry and regulators will definitely, along with big data, AI, ML, be part of the solution, because if they are not, then they will be against the solution, and fintech will reach out to 8.2 billion consumers and 5.8 billion workers to create a better utopian world despite politics, despite government, and despite bureaucracy. At least that's the vision I have, and hopefully the panelists have. Thank you very much for your time, and enjoy the rest of Singapore FinTech Festival.